Welcome to Phase E of the inventory and cost accounting cycle. In the last section, we disposed of variances and settled actual cost against standard. Now we turn to the inventory itself, keeping records accurate, counting what is really on the shelf, and making sure the value on the balance sheet is honest. By the end, you will understand how to control movement, run counts, test for write-downs, and close the period cleanly. Let us begin. Here is what you will be able to do by the end of this section. You will explain the difference between perpetual and periodic inventory systems and know when each fits. You will apply cycle counting using ABC classification to focus effort where the value sits. You will define lower of cost or net realizable value, or LCNRV, and build an obsolescence reserve by age. You will identify the reconciliation items that hide at period end, like goods in transit and the GRIR account. And you will record write-downs correctly under both GAAP and IFRS. Let us start with how inventory moves. Here is the foundational rule of inventory control. Every physical movement must be matched by a same-day system transaction. The moment stock moves, the record moves with it. Location transfers get transfer notes. Supplier returns go out with a debit memo. Customer returns are quarantined first, then inspected, and only then restocked or scrapped, never blindly put back. Consignment inventory is tracked separately because the consignee does not own it, even though it sits in their warehouse. Intercompany transfers are logged too, and physically, oldest stock ships first, FIFO rotation enforced right at the picking face. Get this discipline right and your records actually mean something, which raises the question, are those records updated continuously or only at period end? The surprising part for many people is how different these two systems are in practice. A perpetual system updates inventory records continuously at every receipt, issue, transfer, and sale. You get a real-time balance and real-time cost, and you can spot a shortage the moment it happens. That is why it is preferred for operational management. A periodic system, by contrast, only calculates quantities and costs at period end when a physical count is taken. It is simple, but you fly blind between counts. Cost of goods sold becomes a residual, beginning inventory plus purchases minus ending inventory from the count. For manufacturing or any company with significant inventory, periodic simply is not recommended. But what if you cannot take a count at all? Sometimes a full count is not possible, an interim period, an insurance claim after a fire. Two estimation tools fill that gap. The retail inventory method, used by retailers, applies a cost-to-retail ratio, total goods available at cost divided by total goods available at retail. Multiply ending inventory at retail by that ratio, and you get ending inventory at cost. It is useful for interim reporting, but you still need a physical count at least annually for verification. The gross profit method estimates COGS as net sales times 1 minus the gross profit percentage, then backs into ending inventory. Here is the key thing. The gross profit method is estimation only, never acceptable for the financial statements themselves. So when accuracy truly matters, you count. Most people assume you have to shut the warehouse down once a year and count everything. There is a smarter way, cycle counting. You count a rotating subset continuously throughout the year, focusing on what matters most. ABC analysis classifies items by annual dollar usage. Items are the top 20% by value, often 80% of total inventory value, and you count them monthly. B items, the middle 30%, get counted quarterly. C items, the bottom 50%, annually. The beauty is that errors surface within weeks instead of at year-end, and the warehouse keeps running. That is why cycle counting is preferable to the full physical count for ongoing control. But sometimes you still need the full count, and how you run it matters enormously. The full physical count is the once-a-year event where the entire inventory is counted at one time, typically at fiscal year-end. To make it reliable, the environment is locked down. Production is paused. Movements are frozen so nothing shifts mid-count. Pre-numbered tags are issued, and every item is tagged as it is counted, so you can prove what was and was not reached. This freeze is not bureaucracy for its own sake. Without it, an item counted, then moved, then counted again, double counts your inventory and inflates your assets. The discipline of the freeze is what makes the number trustworthy. And there is one more safeguard that keeps counters honest. They should not know what the system already says. Here is a control that quietly does a lot of work: blind counting. Counters do not see the system quantity before they finish their count. Why does that matter? Because if you know the book says 40, it is tempting to write 40 and move on, and a real shortage stays hidden. Blind counting forces an honest, independent number. On top of that, count teams must be independent of the regular warehouse custodians for the items they count, so the person responsible for the stock is not the person verifying it. Pre-numbered count sheets are issued, and everyone must be returned. None can quietly disappear. Recounts happen whenever a variance exceeds tolerance, and each sheet is signed by the counter and a supervising witness. Now, once you have those numbers, you have to reconcile them. Once counting is done, the physical quantity is compared to the system, or book, quantity for every SKU. Within tolerance, it is accepted. Outside tolerance, investigation is required before any adjustment is posted. You never just plug the number. The investigation works through the usual suspects: timing differences, where items were received or shipped during the count window and not yet recorded; counting errors which trigger a recount; system transaction errors; and genuine shrinkage from theft, damage, or evaporation. Every adjustment above materiality needs management approval. And here is the part auditors care about most: patterns. The same items, the same shifts, a consistent direction of loss. Those are investigated as possible systematic theft. A clean count means book equals physical. With quantity confirmed, we ask whether the value is still right. Counting the stock is only half the job. The value matters too. Under both GAAP, that is a SC 330, and IFRS, that is IAS 2, inventory must never be carried above its net realizable value, or NRV. NRV is the estimated selling price, minus any estimated costs to complete, minus estimated selling costs. If NRV falls below cost, you write the inventory down to NRV in the period you identify the problem. Here is the rule people get wrong: you never defer the loss to the period of sale. The test runs at every reporting date, not just year-end. Watch for the indicators: declining market prices, technological obsolescence, approaching expiry, customer cancellations, demand collapse, physical damage. When any of those appear, the value is at risk. And how you record that write-down depends on which standard you follow. This is where GAAP and IFRS genuinely part ways, and it is worth knowing both. Under GAAP, a SC 330, the write-down establishes a new, lower cost basis. That basis is permanent. No subsequent recovery is recognized, even if the market bounces back. Under IFRS IAS 2, you instead use an allowance account, a contra asset, which preserves the original historical cost on the books. And because the cost is preserved, a reversal is permitted if circumstances change, but only up to the original cost, never above. So the same inventory, the same recovery, produces a different result depending on the standard. In practice, this means you must know which framework your client reports under before you touch a single number. Now, for items not yet fully impaired, there is a more gradual tool. For items showing signs of trouble but not yet fully written down, you build an obsolescence reserve, an allowance set by how long the stock has aged. The standard buckets work like this: 0 to 90 days carries 0%, 91 to 180 days, 25%, 181 to 365 days, 50%, and over 365 days, 75 to 100%. Those percentages are management estimates, reviewed at each assessment date, not carved in stone. Any write-down or reserve change above materiality needs finance director approval. And when written-off inventory still has scrap value, You record the scrap at NRV and the remaining cost becomes the write-off expense. With value settled, only one task remains, closing the period cleanly. Before the period closes, the full inventory reconciliation pulls everything together. The inventory subledger total must equal the GL by category, raw materials, WIP, and finished goods, and every difference is investigated and resolved. Goods in transit, where title has passed per Incoterms but the goods are not yet received, are accrued. Debit inventory in transit, credit accounts payable. Consignment is confirmed separately and stays off the consignee's balance sheet unless they own it. The GRIR account, goods received but not invoiced, or invoiced but not received, is cleared and reconciled monthly, with any unmatched balance over 60 days investigated. Open production orders beyond the expected cycle time are checked for booking errors. Period-end accruals book the standard cost of items received per the GRN. When subledger equals GL and GRIR is clear, the period closes. Let us pull the key points together. Let us bring it together. Every physical movement is matched by a same-day system transaction, with consignment tracked separately and FIFO enforced at the picking face. Perpetual systems give you real-time control, and cycle counting by ABC classification catches errors within weeks. Counts must be blind and independent, and every variance outside tolerance is investigated before any adjustment is posted. Inventory is tested against lower of cost or net realizable value at every reporting date, and remember GAAP sets a permanent new basis while IFRS allows reversal. Finally, the subledger must equal the GL, with goods in transit accrued and GRIR cleared before the period can close. Next, in Phase F, we relieve inventory and recognize cost of goods sold. Thank you for completing this section on inventory control and valuation.